What's going on, guys? Welcome back to Let It Grow Investing. Thank you very much for being here for the first episode of 2025. And man, we've got a lot to cover. I have been busy in every other direction than finance. We got a busy week ahead for me. Weather coming in. We had a little bit of snow on Friday, so I was out Friday night salting. Broke a spreader. Fixed that Saturday morning, tore that apart, and then went back out Saturday night for a couple pre-treats for the event that's coming in tomorrow, which is strange, but that's what the customer wanted. So I went ahead and did that. I'll be back out tonight doing some salt, and then we're probably out at 4 a.m. tomorrow for probably a 15, 16-hour shift of plowing, salting, shoveling, all of that fun stuff. Plus you throw in, all the last minute stragglers that, hey, I need this property done, or hey, I need my driveway done, or whatever. And I got to manage all that, send out all the schedules to all of my guys, and make sure that everything's covered. And hopefully we have very minimal breakdowns or any sorts of problems. So that is what's going on with me. So busy start to the year. Active weather pattern, going to be nice and cold here on the East Coast, and we will be out there, trying to keep things safe and passable for everyone that we service. That is a lot of what's going on with me. That's what's taking a lot of my time right now, and just a lot of prep that people don't think about. A lot of people just think, hey, it's snowing Monday. You go out Monday and you do what you got to do, but there is so much more to having all the operation side of it in place, ready to go for the big event. That's what's up with me. We are definitely rolling into 2025. A bit mixed here with what is going on in the market. So I did want to go ahead and pull that up. I'm going to pull up my portfolio and pat myself on the back for the start of 2025, which actually looks pretty good for me and not so great for others. But we did have a nice bounce back on Friday. Let me see if I can't pull up my screen here. Let's go ahead and share the screen. And I will share my E-Trade here. So, this is what I'm looking at. We've got individual. This is me, 1.76% up. The purple line, and everyone else is down. So, I like that divergence for myself. Everyone else is negative. I'm in the positives. Definitely fueled by Tesla, definitely fueled by Palantir coming back up. We had ABAT has been on a tear. They were down at like 90 cents, and now they hit like 350, and now we're probably back down around 250. But I bought a little bit more, under $2. 247. They dropped in the after hours, but a nice run on this. Let's do the 1 month. So we definitely were down in the 86-cent range. Battery recycling plant out in Vegas. We've talked about them a lot years ago at this point. We bought into this one. It's destroyed me, right? This is one that I bought as ABML. They, I don't know if they merged or whatever happened with them, but then they were brought in as ABAT, and negative results here, right? So I've lost $7,100 on this, and total market value is only $12.76. So not one that I'm really so proud of. But hey, guys, that's what happens with some of these. I probably should have closed this and had a lot tighter of stops on it when I did this, but it didn't happen. So I'm in this negative hole, and it doesn't really make sense to sell it at 80 cents, where I'm just losing money. I would just ride this thing to zero if it took that, because I would have got $600 out of the $8,300 that I put into this thing. So. I'm going to ride this one out. We're going to, kind of see what happens with this one long term. That's not the way I want investing to go, but that's what happened with this one. So learn from my mistakes and, change it around for you. But this one got some government grants, direct offering. We've got, I forget the investment from the government, but they did get some grants to start up another property here. So we will see what is going on there. But I did want to talk a good bit about what we can be aiming for 2025. I see a lot of people, some blindly following me. They just read the headlines and say, oh, I'm buying this or I'm buying that. Please don't do that. Please do not do that. Do the homework yourself and understand that my portfolio isn't going to be your portfolio. Understand that the stocks that I'm investing in might not meet your criteria, right? I'm setting up for retirement in, I don't know, 15 years. If I can get there sooner, that'd be great. At least to the point where I don't have to do whatever. I can pick and choose the things that I want to do, and have that freedom financially, have that freedom to do that. Some people are investing to buy a house in 2 years. Some people are 3 years from retirement. Everyone has a different trajectory as to what they're doing and what they should be buying. We've talked about the rule of 100 or the rule of 120. You subtract your age, and then you see how much you should have in equities versus bonds or other forms of investments. So take a look at that. There's definitely things on like Investopedia as to the way that your portfolio should be managed. If you have questions about that, I'll try to help you, but it might be a case where you need to talk to a financial planner, financial advisor, someone that does this professionally, right? This is kind of my journey that I'm on, the way that I'm looking at things. Sorry, I always keep myself in the small square and forget that I'm trying to show you guys everything for the market, right? So, so definitely take a look at that. We are looking at the NASDAQ coming back up big on Friday. We did see that. But so what do we want to take a look at, right? We really want to take a look at what stocks or what funds can be, added to for your needs, right? So there's definitely things that people are going to be buying into. The big names that we've talked about, the NVIDIAs, the Apples, the things like that. Do we want to buy them and hold them long term? And a lot of those, I think we do, right? Another way to do it, as we've talked about, is ETF. So another one that someone brought up to me that has been outperforming the market is the Fidelity Contra Fund, which this one, it looks like it's mimicking the SPY growth portfolio a little bit. But this one, a financial friend of mine was at a conference, and the manager of the Fidelity Contra Fund was there, and they've been outperforming the S&P for I think the past few years, and probably since their inception. So he was saying that this one, I can just throw money in it and let it run. Your expense ratio, I think it was like 0.3. Not too crazy, but there's other ways to do similar for cheaper. I could look at the fees here. We can take a look at that. Fund redemption, 0.39 management fee. So, not too crazy there, but there's other funds that are going to be less management fees. And you can probably take a look at some of those as well. So when we're looking at this, though, right, if we're looking at the portfolio here for the FCNTX, the Fidelity Contra Fund, we can take a look at the breakdown. We can take a look at where these funds are invested, right? Meta, NVIDIA, Berkshire, Amazon, Microsoft, Apple, Eli Lilly, Google, and Netflix. Typical household names where 57% of your money is being invested into. So you can, kind of follow this, add into some of these individual positions. You can, buy your own baskets of these and not have it be managed by Fidelity, and you're just buying these names by yourself. Or you can simply just buy FCNTX and say you put $1,000 in, it's going to break down. 15% of your money here is going to go into Meta. 8.7% of your money is going to go into NVIDIA. So if you're going to, average in to this position, you can, put in whatever amount of money you need to. Shares are $21.44. So if you're only looking to buy, $100 a week, you can just, put in five shares worth, and you don't really even have to get fractional share investing like you might on some other things. If I'm looking at QQQ, for example, we take a look at that. You got to, on E-Trade, you'd have to buy a $518 share. If you're trying to buy weekly, that might be a little too steep for you. So there are other funds that you could potentially buy, a smaller amount, even on an E-Trade that doesn't allow for fractional share investing. You could do that, right? So that's an option. But yeah, QQQ, if we look at the performance, this is one thing I wanted to take a look at. QQQ, the performance of $10,000 of growth over the past 10 years would have turned into $53,000. Easily outpacing inflation, easily outpacing, most other investment strategies. And, you can kind of set it and forget it. A lot of people are pointing to the fact that the market could be broadening out, could be a good year to get into other staples or other things that might be healthcare or whatever, outside of tech, right? So QQQ might have less returns this year, but I think over time you're going to get great returns out of QQQ. And, you're going to be heavily invested into the NASDAQ, which is going to typically be a quicker grower than the Dow, right? So if we look at SPY G, you're going to get a lot of similar plays where the SPY G 10 grand would have grown into about 40,817 portfolio. You're going to have a less in the way of widening out. You're going to be more into tech. So this is going to be more tech focused, right? All of these except Eli Lilly are tech stocks, right? So that is something we can take a look at too. Now, if we look at just simply going into SPY, which is going to be the S&P 500 ETF, let's see what kind of changes we get there. It might be the other one. It had the top 10 holdings accounted for around 61%. In SPY, you're going to get these top 10 holdings only accounting for 34%. So more companies, a little bit wider of coverage as to what they're going to be invested into. But overall, these are all still tech names, right? Berkshire, maybe not, more conglomerate. But the other ones are still going to be tech, although in smaller amounts than the growth portfolio, right? So the growth portfolio is really going to focus more on the ones that are growing faster, quicker revenue, quicker earnings. And the SPY is going to overall encompass all of those S&P 500 companies. So again, if you're younger, maybe you want to take more risk and have that growth portfolio. If you're 40s to 50s, maybe you just want SPY. If you are, reaching retirement age, maybe you want something like Noble, which is going to be a dividend aristocrats ETF, which you're going to get less in the way of returns, but they're also going to pay you, more in the way of dividends. So 10 grand would have turned into 26.5, although you probably get around 2.5%, 3% on, actually it's a little bit low right now. It's only 1.4. But that's probably because it's grown significantly over the past couple years. Yeah, so we were down 62. Now we're at 99.42 or 99.99 actually in extended hours. So definitely had some growth there, but the dividend is getting a little bit low. So that might be a little bit teetering on overvalued right now, I'll say, without actually looking at the portfolio. But if we look into the names, we can take a look at the PE values of these different different companies that are in here. So Emerson's at a 45. Seems a little bit stretched for Emerson Electric. Financial stocks tend to be cheaper. Genuine Parts, I'm sure that's automotive, but automotive, but I'm not too familiar with how they do. Dover, what is that? Utility? Machinery. Walmart, Grainger, T. Rowe, Fastenal. So a lot of, more staple type names, those financial type stocks that are going to, return a little bit different for you. So definitely take a look at what you're investing in. I just don't want to see people blindly buying into, SoundHound. It's popping. We got to all chase it. I don't want everyone to simply just rush into any one name without knowing what it's going to do. It is a speculative name. If you have speculative dollars that you want to put into it and you're near retirement, understood, go for it. But if you don't, and you're counting on all of those dollars to be there within 3 years, it's going to be a tough road to chase some of these speculative names and not know what's going to happen. And if you plan to stop working and not investing, something like a SoundHound that just took off, right? It might not be a good play for you if you need those dollars in the short term. So think about that, right? Think about, what do I want my portfolio to look like? We're at SoundHound has downside, right? I think it'll grow. But I think the revenue is really going to have to match those earnings, right? They're going to grow that revenue really quick, but is it going to make it to the bottom line? Are they going to have the margins that they need to have in order for the stock price to stay elevated? So a lot of different things here that might not work for me. They might work really well for you. For example, I got out of Johnson & Johnson. And now this one looks like it's got decent upside, but man, they've just been stagnant for so long, and it really hasn't gone anywhere. They might turn around, but for me, I want to see a little bit more growth out of the names. I mean, this is a flat chart trending down over the past 4 years, right? If we look at the start of 2021, we were sitting at like 160, and now we're at 144. Could it pop to 170? Yeah, it could. But at the same time, do I want to be strapped here with money that is just really not going anywhere? So for me, I want some of those larger cap names that can potentially return more in the way of growth for me. So that's where I'm trying to invest a lot of my dollars right now. Something into like an AMD, where I still think that this thing is getting spring loaded. We tried to pop above 200. We came back down. We've had a little bit of sideways action, up 4% on Friday, but we have 47% of upside. I think more and more people are going to be building out that AI, and we've got a lot of hyperscalers that are going to be building on AMD. So I think that could be a lot more growth than J&J that is constantly getting into their own way. We had a lot of the different lawsuits. Yes, a lot of that is getting settled, but I don't know that I want to rope all my money into that when I could have something like an AMD or a Micron or a PayPal that could potentially pop a lot more, or even Nike that has been kind of sold off. I'm out of 3M, right? Say instead of 3M, I would personally want to go into Micron. They are trying to build up the HBM chips for AI and really trying to focus on that to get a larger piece of the puzzle there. So I do believe that there is the person that needs the Johnson & Johnson or the Micron or 3M or Micron, either way. But you really want to take a look at what you have, where you're trying to be, and think, how do I get there, right? Walmart, good for some, not great for everyone. I'm considering getting out of even Disney, right? Disney's been sideways. I'm really thinking of selling Disney at like 125 if it gets there and just getting out of it. McDonald's, I trimmed at 302, and it hasn't really gone anywhere. We had a little bit of the scare with what was it, E. coli or something in their sandwiches. I don't know where this one's going to go, but do I want to leave my money into McDonald's? If I'm kind of capped out here, 9% of upside, the dividend is limited. Would I rather be in a UPS? Potentially, right? Like, I mean, you got more upside. You've got 20% of upside on a UPS. You've got more in the way of this dividend, right? 5.25%, or even throw it into O. O is going to get you around 6% right now. And you've got more in the way of upside than what McDonald's is going to be. So that's really the thing here, guys. I think that some of these are going to be really strong plays. I don't know that I want to just blindly buy the things that haven't really been returning just to say that, hey, yeah, well, I think this is going to go. I don't want you to do that either, right? I don't want to crowd into Palantir just because. I think that they have their place. They have, certainly the momentum behind them, but there is a lot of risk associated with buying a Palantir right now at the prices that they're at. Long term, if you've got 10 years, I think that Palantir is going to be a great play. But right now, your valuation is stretched. So maybe you buy it now, but it's going to take you 5 years to actually see any sort of real growth from this. But I think in that 5-year time frame, this comes back down to 60. And that's when you start averaging in bigger chunks, right? If you want to buy a couple shares right now, if it's in your wheelhouse, if it makes sense to your portfolio, I think go for it. But you really want to weigh the valuation, what type of portfolio you're trying to build. Do you really want growth? Is the valuation good for your timeline? So mine and yours isn't always going to match. You got to buy the stocks that are really fitting for you at a valuation that works for that timeline that you're on. I definitely think for me, I have much of a barbell approach. I definitely have goals that I'm trying to get to, as far as what's in my portfolio and things that I would buy. I'm still looking for more SOFI. I still think that there's more growth there. I like it here. I'd like it to come down a little bit more before I'm probably going to be buying more. Definitely energy. I'll probably get into more Chevron, right? I think that's probably a good name. I'm definitely watching N phase. If we go down more, you'll see more red in my portfolio. It's out there. ChargePoint, ABAT. I talked about that one. Neo, that's brutal. Civitas, man, I still really want Civitas to work. I do think that is one that I can be buying here. And I have started buying down at that like $43 range. Still got some upside here from Civitas, and average price target is $70.80, 47% of upside, decent amount of dividend. We've got buy ratings coming in. I think there's going to be more demand here going forward. They do that special dividend, which has been helping greatly. So you've got this 4% base dividend, and then I think if they do the special dividend included, it's around 10.5%. So again, I am sort of building my own, I'll call it an ETF for lack of better terms, but my portfolio is pretty diverse. There's certainly things that I think we can buy at any given point in time for our own portfolios, but there's nothing wrong with simply buying an ETF that works for you. Say you just want to throw money into the SPY and let it grow, right? I think that is certainly a fitting play for most investors. I think it's a very well diversified plan. And if you don't want to look at this thing every day like I tend to, I think that is probably one of your best bets, is to simply find the portfolio or the ETF that works for you, buy into that. The cost on buying the SPY is next to nothing. What is it? It's 0.05 maybe. 0.09. I thought it was cheaper than that, but still very cheap for a fund that you can just simply buy and keep holding it. Right. So that is a great way to go. But that Fidelity Fund, FCNTX, that is another one that has been doing really well. I think, again, a little bit overexposed to tech, but that does give you that growth that they are after. And it's going to kind of mimic the SPYG or the triple Qs, and that could be another way to go, although it's a little bit more expensive. What is ARK doing? That bruise on the arm, that is ARK Invest. Coming back up here recently, I know Cathie Wood's been selling out of more Tesla as she's been, more bullish on it, but also selling it. Tesla numbers, their deliveries came out a little bit under. So yeah, if we're looking back in 21, it was at 146 and now it's at 60. So that's painful. What's the portfolio do over the past 10 years? If we look at performance, we're probably still going to be positive. Yeah. We had this big run up in 20 to 22. 10 grand would have turned in around 31,000. But this was the hype phase of all things ARK through this area. And, if you bought in that time frame, you're probably not doing too well. And I did buy in that time frame. I think I got caught in to a lot of that growth, a lot of that hype. And I'm negative on it. I'm not going to lie. I'm negative on ARK in my my IRA. I do think that it is going to come back at some point in time. A lot of these growth stocks, as inflation comes back down, we're going to start to see some of these growth names, pop back up. I do think that some of the small caps, mid caps should do well this year. I still think that large cap tech is going to be stable. I think that is a good place to park some money. So, your SPYG or your triple Qs could be a good spot to put some of that money. But having diversification into other areas is definitely going to help your portfolio long term. Tesla, I did want to go over those numbers real quick. This thing dropped like a rock after they reported less deliveries than expected. Maybe I need the 5-day. Yeah, here we are. We were at like 423. We also had the bombing in the Cybertruck that was outside of the Trump Hotel. And people were, I don't know if people thought that this was just a Cybertruck exploding or if people overreacted, but I think it sold off too much, right? So I bought down here in like the 380 to 390 range and came back up to about 412. I still think long term this is still going to go. I'm sure there's negative numbers here on analyst research, but with Elon getting more involved in politics and hopefully having a little bit easier path of regulation for the company, I still think they're going to do well. Rivian actually posted better numbers on deliveries and production for 2024 than previously thought. So they were actually up 24% on Friday. Oddly enough, we're probably buying one, and I'm probably going to get off of here and put a deposit down on a Rivian R1S and probably pick that up Wednesday if I can get out, get away from the snow for a second or get away from the snow work. I'm sure there's still going to be snow on the ground. I'll probably pick that thing up on Wednesday. The Plaid is, man, it's incredibly fast. It's insane how quick those things are. We're kind of capping out on space, right? My trucks turn into snow vehicles in the winter. We got a soccer game here in a couple hours. So yeah, I'm a little bit busy if you haven't caught on. So we've got, a loaded up Tesla, too much stuff in it if we need to take any other kids to a game, or all my gear for coaching, plus, everything else. It just gets way too crowded in there. As a commuter, it's, I guess, a little bit too nice for just a commuter car, but that's what it's been doing. And, we're thinking just kind of go with the SUV that's going to do a little bit better in the snow, haul everything a little bit better, and kind of be that one multi-purpose type vehicle. So that's kind of the change that we're making. It's still going to be the quad motor, which is still going to be faster than it needs to be. I think they're 830 some horse or something like that. We've test drove a couple of those. One like right over the Christmas holiday. Went down there and test drove one. I'm actually going to be buying a used one, so let someone else take the depreciation. And it's only got like 3,000 miles on it. So I think that's the plan. So that is what I've got going on. A little bit of snow, soccer, buying a new car, getting everyone set up, trying to manage a portfolio here, try to keep the podcast going. But that's about all the time I got for you guys today. So thank you very much for stopping by. Please make sure that your portfolio is doing what you need for 2025. Don't simply buy it because I'm buying it. Don't buy it because, Wall Street Bets said to do it. Do what you need to do for your portfolio. Look at the valuations, look at the structure, see if it's going to get you where you want to be, right? So don't simply just say, oh, well, so-and-so said buy 1,000 shares of SOFI and tuck it away, and you're going to be set within 15 years. Is that a plan? It could be, right? It could be speculative. It could go, belly up at some point. I don't necessarily see that happening, but don't just buy it because someone told you to do so. Do the homework, look at the valuation. Is it a good time to buy it? Are the margins right? Is the business right for you? Is the timeline right for you, right? So that's all I got, and be safe out there, and I'll catch you guys in the next one. Take care.